March 2024, the Bank of Japan raises interest rates for the first time in 17 years, ends negative interest rates, ends a policy that had been in place since 2016, July 2024. The BOJ raises rates again. Markets convulse. The yen surges. In 72 hours, the Nikkei drops 12%. It's the largest single-day crash in Japanese stocks since 1987. August 2024, U.S. markets panic in sympathy. The VIX, the volatility index, spikes to 65. That's a number you typically only see when things are actually breaking. September 30, 2024. Treasury Department data lands quietly. Japanese investors had sold a record $61.9 billion in U.S. Treasury bonds in the previous 3 months, the single largest quarterly sale in modern history. China sold $51.3 billion in the same window. October 2024. The 10-year Treasury yield, the rate that your mortgage, your car loan, your home equity line is benchmarked against, holds above 4.2%. Doesn't come down the way people expected after the Fed started cutting. You weren't imagining it. That's the part I want to start with. You refinanced or bought when rates were low. You did the math. You read the articles. You followed the advice. And then something changed, and the advice stopped working, and nobody explained why. I started pulling Treasury International Capital data, BOJ policy filings, and Federal Reserve flow of funds reports because I wanted to understand what was actually happening to interest rates after the Fed started cutting. What I found isn't a conspiracy. It's a structural outcome. And once you see it, the last 18 months of your financial life make a lot more sense. If that sounds useful, stay. Hit subscribe. And if this helps, give it a like. Most people think about interest rates the wrong way. They think the Federal Reserve sets mortgage rates. The Fed cuts rates. Mortgages get cheaper. The Fed raises rates. Mortgages get more expensive. Clean, simple, logical. Except that's not really how it works. And 2024 proved it in an uncomfortable way. The Federal Reserve controls the federal funds rate, the overnight lending rate between banks. It's the short end of the yield curve. Your mortgage, specifically a 30-year fixed mortgage, is priced off the 10-year Treasury yield. Those are two different instruments. They're related, but they are not the same thing. In September 2024, the Federal Reserve cut rates by 50 basis points, a half percentage point cut. That was larger than most analysts expected. It was described as the beginning of a rate-cutting cycle. People who had been waiting to buy a house, waiting to refinance, waiting for some relief, felt the window opening. The 30-year mortgage rate at the time was around 6.1%. By October 2024, after the Fed cut, after the announcements, after the coverage, mortgage rates had climbed back to 6.8%. The Fed was cutting. Mortgages were rising. This is the thing that makes people feel like they're doing everything right and still losing ground. Because the mechanism isn't broken. It's just operating in a way that wasn't explained to them. Here's what was actually happening. The Federal Reserve controls overnight rates, but mortgage rates are set by the 10-year Treasury yield, which is set by the global market for U.S. government debt. That market is enormous. $28.1 trillion in Treasury securities outstanding as of late 2024. It includes the Federal Reserve. It includes American banks. It includes pension funds, hedge funds, domestic investors, and it includes foreign governments, specifically Japan, which holds $1.1 trillion in U.S. Treasuries, the largest foreign holder. When Japan starts selling, it doesn't matter what the Fed does. More supply hits the market. Prices fall. Yields rise. Mortgage rates follow. That's the mechanism. The Fed loosened one dial. Japan was tightening another. To understand why Japan started selling, you have to understand why Japan was buying in the first place. And that story starts around 2016. The Bank of Japan was dealing with something economists had theorized about, but almost never seen in a major economy: deflation. Not inflation, deflation. Prices falling, year over year, for more than a decade. To fight this, the BOJ did something extraordinary. It took interest rates negative. You read that right. If you held cash in a Japanese bank, certain kinds of deposits, you paid to hold it. The interest rate was minus 0.1%. The effect on Japanese investors, the life insurers, the pension funds, the enormous institutional pools of capital that Japan has accumulated through decades of savings, was predictable. There was no yield at home. So they looked abroad. U.S. Treasuries in the mid-2000s were paying 2%, 2.5%, sometimes 3%. For a Japanese pension fund comparing that to a negative domestic return, U.S. Treasuries were extraordinarily attractive. Japanese institutions poured into them. By 2020, Japan had accumulated over $1.2 trillion in U.S. government debt. There's a cost to this trade, though. When a Japanese institution buys a U.S. Treasury bond denominated in dollars, they're exposed to currency risk. If the yen strengthens against the dollar-denominated return erodes when converted back to yen. So most of these institutions hedge that currency exposure. They buy contracts that lock in an exchange rate for future conversion. That hedging costs money. It's not free. And the cost of the hedge goes up when U.S. interest rates rise, because the hedge is based on the interest rate differential between the two countries. In 2022 and 2023, the Federal Reserve raised rates aggressively, from near zero to over 5%. The cost of hedging a U.S. Treasury holding for a Japanese institution exploded. At the peak, it cost roughly 5% per year to hedge dollar exposure. A 10-year Treasury paying 4.5% minus a 5% hedge cost was a negative return. The trade that had made sense for years had flipped. And then, March 2024, the Bank of Japan raised its own policy rate for the first time in 17 years. Japanese bonds, which had been paying nothing, started paying something. The comparison changed. Why hold a hedged U.S. Treasury with a negative net return when domestic Japanese government bonds, JGBs, were finally generating positive yield? The answer was, you don't. You sell. I want to explain the bond market mechanics here because this is where most coverage either skips over it or buries it in jargon. The actual math isn't complicated. Bonds have an inverse relationship with yields. When bond prices fall, yields rise. When yields rise, borrowing costs rise. This is not a policy choice. It's arithmetic. When Japan sold $61.9 billion in U.S. Treasuries in the third quarter of 2024, that is supply entering the market. More sellers than buyers at the current price means the price has to fall to find buyers. As bond prices fall, yields go up. As the 10-year Treasury yield goes up, the mortgage rate goes up. The benchmark moves, and everything priced off it moves with it. The Federal Reserve in September 2024 cut the overnight rate by 50 basis points. But the 10-year yield was moving based on a different set of pressures. There was $61.9 billion in Japanese selling. There was $51.3 billion in Chinese selling. There was ongoing quantitative tightening. The Fed itself had been selling treasuries from its own balance sheet since mid-2022 as part of unwinding its pandemic-era interventions. You had the Fed easing from one direction and a combination of foreign selling plus QT pressuring yields from another direction. The 10-year yield didn't cooperate with the Fed signaling. It went up. Mortgage rates followed. The people who had been waiting for the rate cut to create refinancing opportunities or buying opportunities or some kind of material relief, those people were watching the wrong dial. They were watching the Fed. The The relevant number was moving for reasons that had nothing to do with the Fed. This isn't new, by the way. The relationship between foreign Treasury holdings and domestic rates has been documented. In 2013, there was a period called the taper tantrum. The Fed indicated it would slow its bond purchases, and the 10-year yield spiked from 1.6% to 3% in about 5 months. In 2022, the UK pension system nearly collapsed because of rapid movements in UK gilt yields, driven by forced selling by pension funds caught in leverage positions. The mechanism is well understood by anyone who reads the filings. What isn't communicated clearly to the person trying to decide whether to buy a house or refinance is that mortgage rates are not just a domestic policy question. They are a function of global capital flows, and those flows can move in ways that directly contradict what domestic policymakers are doing. I want to be specific about this because it's instructive. The institutions that hold long-duration U.S. Treasuries, the Japanese life insurers, the pension funds, the sovereign wealth managers, had been sitting in a difficult position for a couple of years by Q3 2024. Hedging costs had eaten their returns. Their domestic market was starting to offer competitive yield for the first time in a generation. The decision to sell wasn't reckless. It was rational. They sold into a market where there was still demand. They locked in relatively high prices for bonds they'd held for years. The losses, where they existed, were manageable given the scale of the institutions. Who bought? Primarily domestic U.S. investors, pension funds, money market funds rotating into longer duration, and some foreign buyers who weren't running the same hedging calculus. The buyers paid prices that had already moved lower. They took on the duration risk at higher yields. What happened to the ordinary person trying to buy a house in October 2024? Mortgage rates that had briefly dipped to 6.1% in September moved back to 6.8% by October. On a $450,000 mortgage, roughly the median home price in the United States at the time, that's a difference of about $200 per month for 30 years. The person who bought in September got a different outcome than the person who waited for the Fed cut and bought in October. Not because of anything they did differently, not because one was smarter or more prepared. The mechanism moved. The timing mattered in a way nobody told them to track. The advice, wait for the Fed to cut, then rates will fall, then buy, was structurally incomplete. It described the Fed's dial. It didn't mention Japan's. There's a number I want to stay with for a moment. $1.1 trillion. That's Japan's current U.S. Treasury holdings as of late 2024. It's still the largest foreign position. Despite the record selling, Japan remains the single largest foreign creditor of the United States government, and the BOJ's policy normalization is not finished. As of early 2026, the BOJ's policy rate is 0.75%. The 10-year JGB yield has reached approximately 2.1%, levels not seen since before Japan began its extraordinary accommodation. JGB yields rose roughly 62 basis points in just a few weeks in late 2025. The research from J.P. Morgan, Goldman Sachs, and Nomura, I've been reading through these, estimates that Japanese institutions could reduce their U.S. Treasury exposure by 5 to 12% over the next 2 to 3 years. That's $55 to $135 billion in additional selling. Gradual, not a crash, but persistent. A consistent seller into the Treasury market, even a slow, gradual one, creates upward pressure on yields. That's not speculation. That's supply and demand in a fixed income market. The carry trade itself, which is the practice of borrowing in a low-rate currency like the yen and investing in a higher-rate asset like a U.S. Treasury. That trade is unwinding. Slowly. The yen carry trade was estimated by various analysts at somewhere between $500 billion and $4 trillion in notional size, depending on how broadly you define it. The August 2024 market convulsion, the Nikkei dropping 12%, the VIX spiking to 65, was a partial, disorderly unwind of that trade. A reminder of what it looks like when institutional positions move quickly. The slow version of this unwind is happening now. It doesn't make headlines the same way, but it shows up in the 10-year yield, and the 10-year yield shows up in mortgage rates. The person doing everything right, maxing out their 401k, keeping their debt-to-income ratio in order, waiting for the right moment to buy, is navigating a rate environment that's being shaped, partly by decisions made in Tokyo boardrooms, by institutions rebalancing decades-old positions in response to a policy change that ended negative interest rates after 17 years. That's not irrational. That's not a failure of personal finance. That's structural. I'm not going to tell you what to do with this. That's not what this is. But the clarity here matters, I think, because a lot of people have been operating on an incomplete map. The map said, Fed cuts rates to mortgage rates fall to buy or refinance. That map is real, but it only shows one part of the territory. The other part, the global demand for U.S. Treasuries, the carry trade dynamics, the BOJ normalization, that part of the map was blank for most people. Understanding that mortgage rates can rise while the Fed is cutting, because of foreign treasury dynamics, changes how you read the next 12 to 18 months. The BOJ has signaled continued gradual normalization. JGB yields at 2.1% are still rising. Japanese fiscal year ends March 31st, and institutional rebalancing tends to happen around that window. That doesn't mean mortgage rates are going to 8%. It means they may not behave the way the Fed's signaling implies they will. It means the 10-year yield is worth watching, not just the Fed funds rate. It means the TIC data, Treasury International Capital, which the U.S. Treasury releases monthly showing foreign holdings, is a more direct indicator of what's happening to the rate you actually borrow at than whatever the Fed announces. None of this is esoteric. It's public data. It's in the filings. It just wasn't on the standard financial advice map that most people were given. Japan holds $1.1 trillion in U.S. Treasuries. It sold a record amount last quarter. Its central bank is raising rates for the first time in a generation. The carry trade that helped keep U.S. rates low for a decade is unwinding. Slowly, structurally, in a way that doesn't make the front page but shows up in your borrowing costs. You weren't behind because you failed. The math changed. The structure changed. The map most people were given was missing a continent. I'll keep reading the filings. I'll keep tracking the TIC data. When Japan's quarterly flow numbers update, I'll document what's changed. If that's useful, subscribe. I'll keep doing this.